Hello everyone, welcome to Stock Trading Tutor channel. If you would like to create a free Demat account, click the link in the description and fill out your details. Now, let's look at profit and loss statement, which is important for fundamental analysis. When it comes to fundamental analysis, there are three major financial statements that every investor studies in order to get a better picture of a company. These are profit and loss statement, balance sheet, and cash flow statement. Let's look at the profit and loss statement. A profit and loss statement or a P&L statement, also known as the income statement, shows the incomes and expenses of a company for a financial year. It categorizes the incomes and expenses under various heads to facilitate easier understanding and analysis. The expenses are subtracted from the incomes to arrive at the company's net profit. Here's a sample of a profit and loss statement. How to read a profit and loss statement. The profit and loss statement is a treasure chest of financial and operating information on a company. Analyzing it effectively can reveal critical information about its current performance and future prospects. To reveal these insights, you must dig deep into each item that is on it. Here are some of the key profit and loss statement items that you should look at. And the things you should look at are the revenue, the cost of goods sold, gross profit, the selling, general, and administrative expenses, the EBITDA or operating profit, the depreciation, amortization, EBIT, interest, EBT or the earnings before tax, and the net profit. We will be looking at this line by line, so in future. Now, understanding the profit and loss statement. The profit and loss statement starts with the revenue earned by the company during a year. All other incomes are added to it and all the expenses are subtracted from it. Incomes and expenses fall into two categories, operating and non-operating. The operating segment consists of incomes and expenses from the company's core business. For example, salaries, rent, and expenses incurred for selling goods and services. The non-operating section contains all the incomes and expenses from the non-core business activities, such as proceeds from the sale of an asset or income from investments. Now, let's look at the profit and loss statement in its segments. First is the revenue. The total income a company generates in a year is called its revenue. It primarily comes from the sale of the company's goods and services, but several other sources contribute to it. Income generated from these other sources are called other incomes. You will find many items under the sales for companies serving multiple segments. You can analyze these to see where the company is doing well and where it is lagging. Consistent sales growth indicates that the customers like the company's products and the management is doing a good job marketing them. This is healthy for the company's stock, but you should also check the sales quality before making up your mind. Companies often sell goods for credit and get paid for them later. They report these sales in their profit and loss statement without receiving any cash. An income statement with a high proportion of credit sales can be dangerous. The company runs the risk of not recovering this money. It also raises questions about why the company was formed to make a high proportion of sales on credit. Although credit sales reduce earnings quality, a high percentage of credit sales is normal in some industries. Compare the company's credit sales percentage with its competitors to check its earnings quality. Next is the cost of goods sold. This is the money a company spends on manufacturing its goods and services. The cost of goods sold, or COGS, includes the cost of purchasing raw material, transporting it to the company's production facility, and converting it into the final product. Companies always try to maintain the balance between reducing the cost of goods sold and maintaining good product quality. The cost of goods sold is the first item to be subtracted from the revenue. The resulting figure is the gross profit. Put simply, it is the difference between what the company earned from selling its products during the year and the cost it directly incurred in manufacturing them. Next is operating incomes and expenses. This includes all the incomes and expenses that arise in routine course of a company's business. Examples include the selling and marketing expenses, rent, wages and salaries, and IT expenses. You will mostly find operating incomes reported as other income on the profit and loss statement. They are the company's sales to arrive at its total revenue. The cost of goods sold is subtracted from the revenue to arrive at the operating income. Next to be subtracted are the selling, general, and administrative expenses, the SG&A. Operating expenses are generally recorded under the head Selling, General, and Administrative Expenses. These expenses come down as the company grows and becomes experienced at various operational processes. However, the management is also pushed to take concrete steps to cut the SG&A expenses, as this can instantly increase profitability. You can always evaluate a company's management by its ability to reduce costs without hurting product quality, operational efficiency, and productivity. After subtracting the selling, general, and administrative expenses, we get the earnings before interest, tax, and depreciation and amortization, which is known as EBITDA or EBITDA. This is calculated by subtracting the cost of goods sold and other operating expenses from the revenue. It is sometimes called the operating income or the operating profit because it does not include non operating items like non operating incomes and expenses, interest, and taxes. Put simply, the EBITDA measures the profitability of a company after subtracting only the expenses that are necessary to run its operations and produce its goods. It is the purest measure of operating strength. In fact, equity analysts sometimes prefer it to the net income as a measure of profitability. Next is the depreciation and amortization. Assets lose value over time because of deterioration and obsolescence. The annual loss in an asset's value due to these is called depreciation. Depreciation is only charged on tangible assets like plant and machinery. Land is the only tangible asset that is not depreciated. For patents, copyrights, and other intangible assets, that is, assets that cannot be touched, the annual loss in value is called amortization. Depreciation and amortization are recorded as operating expenses on profit and loss statement. They are the non-cash expenses because they are charged despite the company not paying any cash. Subtracting the depreciation and amortization from the EBITDA gives earnings before interest and tax or the operating profit. Operating profit is adjusted for non-operating incomes and expenses to arrive at net income or the company's profit for the year. This includes all the incomes and expenses that the company does not generate in the routine course of its business. They are generally not mentioned as the company has a separate category on the profit and loss statement for non-operating incomes and expenses, but all items mentioned after the EBITDA fall under this category. Common examples are restructuring costs, legal expenses, and profit loss from the sale of an asset such as land, machinery, or building. These items are often recorded net of tax. They may also be recorded without subtracting tax, in which case they are taxed together with the pre tax income or earnings before tax to arrive at profit after tax, which is the net profit or the net income. This is a company's annual profit after including all incomes and deducting all expenses. It is the last item on the income statement and it is also called the bottom line. Net income directly impacts share prices because it is either distributed among the shareholders as dividends or retained and invested in future business growth. Observe how a company's net income has grown over the year. This will give you insight into its business strength. Also, see how stable the company's dividends have been and how it is used to retain its income. Companies that invest retained earnings in good growth opportunities continue to do well in the future. Companies that have consistently paid good dividends have a stable and predictable business are also considered good opportunities for investing. Thank you for watching this video. For more videos on stock market and trading, please subscribe to this channel. If you'd like to create a free Demat account, click the link in the description and fill out your details.